You've been told that real wealth requires staying active, timing the market, picking the winners, getting out before the crowd does. Here's the number that broke the story for me: $15,000. One position, never touched again. It became $1 million. No trading, no timing, no watching the news. The money grew because nobody touched it. That's exactly backwards from everything you've heard. And it's exactly right. Let me show you how it happened. One thing before we get into the math, there's a catch to this whole approach. And it's not the catch you're expecting. It's not fees. It's not some obscure account requirement. And timing has nothing to do with it. And it's the reason this stops most people from ever getting here, including me. I'll show you exactly what it is, but I need you to see the number first. Because until you feel what this math actually does, the catch doesn't fully land. Picture this. Someone drops $15,000 into a broad basket of US stocks. The Dow. Not a hot tip, not a promising sector, not a company to read about. The most generic possible choice. That was in 1974, and then they walked away. They don't log in, they don't rebalance, they don't have opinions about the Fed. They just live their life, and the money sits there. 38 years later, through oil shocks in the 70s, Black Monday in 1987, the dot-com collapse, 9/11, the 2008 housing meltdown, every "this time is different" news cycle in between, that $15,000 had become $1 million. Not because they made smart moves at the right moment. They made exactly zero moves. They got rich through every crash, not in spite of them, by doing absolutely nothing. When I first saw math like this, my gut reaction was, sure, hindsight. Give me any 38-year window and I'll find you a winner. The 1974 investor got lucky picking a great starting point. But here's what makes the objection fall apart. This wasn't a hot pick. Nobody chose Dow stocks in 1974 because they had inside information. It was the whole market, the most passive, undiscriminating choice available. Anyone could have done it. Almost nobody did. Now, if 38 years sounds too long to matter to you, hold on. Because 25 years gets you most of what 38 years gets you. That's the compounding curve. The growth accelerates, so you don't need the full stretch to get most of the result. Collins admitted in his writing that he was too smart to do this himself at first. He knew about it and still didn't, because he was convinced he could find something better. I read that and had to set the book down for a minute, because that was describing me exactly. The clearest version of this comes from J.L. Collins. He laid it all out on his site, and it's central to his book, The Simple Path to Wealth. I want to name him here because the work is his, and putting a real person behind a number like this makes it harder to wave away. The link to his site is in the description. For years, I was absolutely certain the money came from being active, from watching, from knowing more than the guy who wasn't watching. Turns out that's exactly backwards, and I can prove it with my own portfolio numbers. Before I tell you the story, I need you to hear another number. How much better does doing nothing actually perform? Buy the whole market and leave it alone, and you outperform roughly 80% of active investors. 4 out of 5. The people doing all the work, the research, the rebalancing, the watching, lose to the people doing none of it. Not because those active investors are careless. Most of them are thoughtful, paying attention, doing exactly what you think you should do. Activity in investing almost never works out the way it feels like it should. The more you watch, the more you tweak, the more you react, the worse you tend to do. Activity feels like control. In markets, it's mostly just friction. Every move creates a tax event. Repositioning means betting you're right about something, and sometimes you're not. Each time you refresh a portfolio, you create an opening to panic about something that isn't actually a problem. I was maybe 4 or 5 years into investing when I had my own version of this lesson. I'm sitting at my desk, laptop open, brokerage tab pinned, second tab for market news, checking positions twice a day, minimum. First thing when I got to work, I pull up the portfolio, lunchtime back at it. I added a widget to my phone so I could check without even opening an app. I was thinking, I can see what's happening. I've got a feel for where things are heading. I just need to not miss the moment when it matters. My coworker at the time was exactly opposite. He dropped some money into an index fund a couple years earlier and completely forgotten about it. Not as a strategy, he just didn't have time to watch it. He asked me once, "What are you always looking at on your phone?" I told him I was keeping an eye on my positions. He said, "Oh, how's your thing doing?" I straightened up, told him it was going well. I set the phone face down on the desk like it was nothing. It was not going well. When I actually sat down and compared numbers, I was trailing his forgotten index fund by 3 percentage points. Not because I made catastrophically bad decisions. I'd made a lot of decisions, actually. That was the problem. Every move had a transaction attached. Transactions meant taxes. And every reposition was a bet. Some of those bets didn't pay off. It all added up. And all that effort had produced something that looked a lot like overhead. The part I find genuinely funny, in a very uncomfortable way, you're not paying for better returns when you trade more. You're paying for the privilege of worse ones. More moves, more taxes, more moments of being confident and wrong at exactly the wrong time. I gave myself enormous credit for being diligent, for caring enough to stay informed. What I was actually doing was generating friction on the account and calling it a strategy. The activity wasn't an engine, it was overhead. So why does letting it just sit there actually work? It sounds like magic, but let me show you what you're actually holding when you set this up correctly. Here's a question I couldn't answer for longer than I'd like to admit. If I'm not picking stocks, who is? The answer flips a switch. Because once you hear it, you realize the index doesn't need anyone to manage it. It's self-cleansing. The companies that shrink and struggle drop out of the index automatically. The ones that grow and win take up more space. You don't have to fire the losers or promote the winners. The market does all of that on its own without your input, which is the entire point. An index fund is one investment that holds every publicly traded company in the market. When you put money in, you own a slice of all of it. Thousands of businesses, teams of people going to work every morning to sell more, build more, serve more customers, cut costs, outcompete the company next door. Your money is attached to all of that effort, every piece of it, while you sleep. I try not to think of it as stocks. That word makes it feel abstract, like trading chips on a table. What I actually own is a percentage of the working economy. Every software update shipped, every package that lands on someone's doorstep, every quarterly beat, a tiny fraction of that goes to work for me. I didn't hire any of those people, never chose a single one of those companies, but I own a piece of what they're building, and they keep building whether I'm paying attention or not. That's different from how most people think about investing. Most people picture picking, finding the right thing, and hoping it goes up. This isn't picking. It's owning the whole game and letting everyone play. This is what was working under that $15,000 the whole time. Not genius, not a timely sector call, not someone watching the news and making savvy pivots. Someone owned the whole thing. The winners, the struggling companies, the ones nobody had heard of yet, and refused to touch it for 30 years. That's it. That's the whole thing. So if it's this simple, own everything, do nothing, why doesn't every patient investor end up with 7 figures? Here's the catch I promised you at the beginning. The strategy is not the hard part. You are. I know that's not the answer anyone wants. People want to hear that the catch is some obscure account setup or a minimum balance requirement or a timing rule with a workaround, something fixable. This catch is different. The only real downside is volatility. The market drops. Sometimes it drops a lot. 2008, portfolio is cut in half. 2020, down 35% in weeks. These are not exceptions. They're written into the deal. Conventional wisdom calls 100% stocks reckless. You've heard it. You need books for stability. That's too aggressive. In the short run, there's truth to that. The ride is rough. But over 20, 30, 40 years, nothing reliable beats it. The recklessness is in the short-term volatility. The long-term outcome is exactly the opposite of reckless. The price of admission is that the ride gets violent. You have to sit through every single downturn without blinking. Here's the reframe that actually helped me. When the market is falling, that's not the strategy failing. That's the admission costs being collected. The $15,000 only became $1 million because someone held through every crash, every recession, every "this could be the end" headline without moving. The drops weren't interruptions to the return. The drops were part of the return. The moments when everyone else sold were the exact moments that separated the people who built real wealth from the people who almost did. I've been in this long enough to watch real money fall off a cliff in a downturn. Money I care about. Money that represented years of actual work. Reading about volatility and experiencing it with 6 figures on the line are two completely different things. I go to sleep with that number in my head. I wake up and it's the first thing there. The pull to just do something, to stop the bleeding, to feel like I made a decision, that pull is physical. Anyone who tells you otherwise has never had real skin in the game. What doing something looked like for me during a rough stretch? I sold, because the loss was accelerating and I was going to get back in when things stabilized. Then things stabilized, which meant they have already recovered part of what I missed. So I waited for a better entry. It never quite felt right, and I ended up buying back in at a higher price than when I sold. I ran a textbook sell low, buy high with real money. I had done this, and it feels terrible in a very specific way. Here's what I've landed on, and I want to be clear, this is my position, not a recommendation for you, but I decided how I'll behave during a crash. Before the crash happens. When things are calm and I'm thinking clearly, I write it down. If I have cash during a crash, I buy more. I don't exit, and on the worst days, I don't check. The crash doesn't get to rewrite the decision I made when I was in the right headspace for it. That's the discipline, and it's not financial, it's emotional. The mechanics of setting this up are the simplest part. You want a total market index fund. Not just the biggest 500 companies, the whole market. Fidelity has one called FZROX with a 0 expense ratio. It costs you literally nothing to own. Schwab and Vanguard both have their own versions with fees close to 0. If you have a 401k at work, check your fund options. There's likely a total market fund in there already. If you don't have a brokerage account, Fidelity and Schwab are both easy to open. No minimum balance required. Takes about 10 minutes. Then automate it. Set a fixed dollar amount to go in on the same day every month. Whatever you can do consistently. $50 or $500. The habit matters more than the size. Set it once, then stop looking at it. 3 steps. That's the whole setup. We just watched $15,000 become $1 million by sitting completely still. But almost nobody starts with a lump sum. The far more realistic picture is a little bit every month for a long time. Here's the part that sounds made up until you see it. Investing $150 a month, roughly what a gym membership and a streaming service costs, can quietly grow past $1 million over 40 years. $150. In the next video, I'm showing you whether that math actually holds up when you stress test it with real numbers or falls apart under pressure. And the math might change how you think about your own timeline. Not a hypothetical one, yours. Now, I'll see you there.